Hello, everybody. Hello, everybody. This is Noah and John, and we are from UrbanDigs, and this is Macro Monday, the first one that we're doing. And if you've noticed, take a look at our new website, guys. You could now join these class sessions, these workshops. It's going to be workshops. It's going to be live events. It's going to be interviews. It's going to be webinars. It's going to be strategy sessions with different experts. It's not just going to be me and John. And you're going to see all this stuff on your calendar, okay, right on your dashboard, and you'll be able to join. If I hit refresh here, I think this will say join now. Let's see. There you go. Join live event. Okay, join live event. All right, so you just come here. I'm going to try to do these things every Tuesday and Wednesday are classes, workshops that I run. Every Monday at 11, Macro Monday. Macro Monday, Johnny. And there's a reason we're doing this. Let me first say, disclaimer. Got to give a disclaimer, guys. None of what we're talking about here is financial advice. I can't believe I'm actually doing this. None of this is financial advice. Please do not start trading on this advice. We are sharing our opinions of what we think is going on, Johnny. And let me just first say, here's my take of what's happening. And I'm curious what your take is what's happening. So basically, this is a prime example of gross negligence on the part of risk management on the part of some of these regional banks, right? You got Silicon Valley Bank, right? You got Signature Bank. Two banks closed over the weekend. Basically, what happened is these guys made big bets on long duration securities, right? Which don't do well at all in rising interest rates environment. If you're going to go buy a US Treasury 4 years ago at 1.5%, and now you can get 4% on that same Treasury, that holding is deeply underwater. Now, since the great financial crisis, okay, because a lot what happened during the great financial crisis is playing into what's going on now and what may happen in the next 6 to 12 months, because this is the tip of the iceberg. I believe I recall what marked the end of the great financial crisis was the suspension of mark-to-market rules, meaning you could have a holding. These banks could have a holding of a treasury, right? Just call it 1,000. They paid 1,000 for it, just for hypothetical purposes, right? The open market now, if they sold it, is 400 or 500 for that same security. So those securities are killed because as interest rates rise, those long duration assets get hurt. And it's okay because you don't have to mark them down, right? But it's not okay if the depositors start withdrawing their money. And as a regulated bank, you need to keep your tier one ratios. You got to keep your assets in line, right? So what do? You need more money. So what do? You either go and try to raise money, which they did and failed, right? That was last week. And if they don't raise money, you got to sell those securities. And when you sell those securities, that's the market. Now that's a real loss. And what happened was an old-fashioned bank run, right? So they failed. And the FDIC, they took over, right? They took over the banks. They completely failed. Now, what you guys need to know, these guys made bets. These guys made bets. There was no risk management. There was no risk controls. There was no hedges against a rising interest rate environment. These guys made bets to make money, and this is what happened. And now you have failures. Now, the problem where this gets systemic is the deposits, right? And we know these are people that, or companies that have payrolls. These deposits, they're only insured up to $250,000. So everyone's like, get the money out. Get the money out as quickly as possible. They had $40 billion in withdrawals on Friday. That's what caused this whole thing. It's a good old-fashioned bank run. So let's go over what the Fed did, okay? The Fed stepped in last night, okay? And they did a couple of things. I want to go over it because this is not a bailout in the sense of the great financial crisis bailout. It's different, okay? First and foremost, this was really done to protect the depositors, okay? The first line right over here, to protect the depositors, okay? The equity and the shareholders, the equity shareholders, look, the shareholders and the unsecured debtors are not protected, are not protected. So the banks failed. And if you had stock in that bank, zero. Or it's going to get sold for $1, or who knows is going to buy it. It's like Bear Stearns. Bear Stearns, John, $2. Remember that whole thing? Okay. That's going to happen here. I don't know who's going to buy them. Someone's going to buy them. The second thing that happened is they opened up a credit facility. This eerily reminds me of the great financial crisis, but this is not the great financial crisis, but this is eerily reminds me of how it started, because I don't know if you guys recall the great financial crisis. Okay. I have this all set up for you guys. I can't, all of these things that you're looking at are FOMC programs and Fed policy statements and other interventions the Fed had to do for the great financial crisis. It started in mid-2007 with Bear Stearns hedge funds, right? Look at all the policies they had to do over the course of the next year and a half, and look what happened with Lehman. These are all TALF, TAF, the money market deposit, the credit line, all these different things, all these different facilities. There's one after another. So when I say this kind of reminds me of that, the Fed created a lending facility. The lending facility is expensive. It's expensive. It wasn't designed to be attractive to do it. Okay. But basically what they're doing is they're calling this a systemic risk exception for these banks, for Signature Bank and for Silicon Valley Bank, where those guys could take those holdings, those treasury holdings, at 1,000 that they bought, right? We talked about in the beginning at 1,000. Even though if they sold it on the market today, it was 400, the Fed's taking it at 1,000. That's the bailout here. The bailout is in the sense of the assets that these companies are pledging as collateral to the Fed, who can hold them to maturity, right? They're basically getting full value, even though they're down 50, 60% on those holdings. And that's the core of what's going on here. So it's a backstop of the deposits. It's a lending facility, right? And you know, this is the most important part. It's not like these banks could go out there and buy stuff for 40 cents, 50 cents on the dollar now and then lend it to the Fed at full par. It has to be as of March 12th, eligible collateral. And that's why we're showing you these types of things. And here's the overnight swap. This is the fee. This is the fee. That's expensive, right? So it's going to hurt. So this is why you're seeing other regional banks today start to get hit, because this was not a bailout of the banks itself. It was really bailout of the deposits, John.
Right. And, you know, you go back to the that list you had of all the Fed interventions back in the great credit crisis, the great financial crisis, whatever you want to call it. And, you know, to me, it's almost what's happening. It's like you squeeze a water balloon, right? It sort of, you know, pops up in between your fingers. And this is kind of what's happening right now as interest rates have gone from, you know, less than, you know, to what, 10 basis points to 500 basis points in the span of a year. So when you get that far, that fast, things start breaking, and they don't break all at once. You see a little break here, a little break there. So this is kind of the first sort of sign that, oh, maybe this fast rise in interest rates is going to break something. And so one of the things to do is kind of step back and take a look at, all right, well, where are general interest rates and where is the Fed rate? And what that is, that's the difference between the credit levels. And that's a credit spread. And what happens is that increases. That's a sign of systemic risk. And that's a sign that, well, maybe things aren't just contained in the banking sector. Maybe there are other places, but, you know, you're looking at, this is Credit Spread Alert, which Noah and I built. And right now, when we're looking at it, it looks pretty contained, Noah.
Yeah. So credit spreads, right? And that's the next element here. Credit spreads are a market signal of potential risk, right? As John said, it's the spread between that riskier corporate debt and the safer U.S. Treasury. And as credit risk rises, that spread's going to widen. Okay. And this index right here. Okay. If credit stress is rising, this index is going to go to the right. Okay. You could see it already went to the right. 1, 2, 3, 4, 5, 6, 7, 8, 9. This is like 10 warning signals from early last year, right? You could see how low it was back in mid 2021. That was the peak. Yeah. Right. That was complacency. And then basically it's just come up, and we've seen what happens now when credit spreads widen. Now you see it. So yeah, we continue to be in a moderately elevated credit risk environment, a moderately elevated, which means it is not anywhere near the pandemic. Look at the pandemic. Yeah. Look at what it did. This thing went all the way up to about here during the pandemic. Right. And again, we built this tool so those of you that don't follow credit spreads could actually keep an eye on this, as long as you understand when it goes to the right, things are getting hairy. And when it goes to the left, things are recovering, kind of a thing. But take a look. OK, where's my little cursor here? Take a look at hold on a second. Look at the great financial crisis. And it really does put it into context. Right. Look at the pandemic. Right, which was just this huge spike just before. Look at the pandemic relative to the great financial crisis and look at where we are now. right?
Well, no, this chart is it hasn't updated yet. It'll update today, end of today, early tomorrow with today's figures. So I anticipate it's going to tick up a little bit. But the whole idea is that, we're sitting at, what level are we on the credit spread alert? Like, what is that, like 2.3, 2.4? Yeah. So we've gone from a little over 0 to 2.4, despite rates having risen exponentially more. And that's the question now is, all right, well, what is going to happen? I mean, you look at what the Fed's doing. Is the Fed going to start, the idea is that the Fed is going to keep increasing rates to get a hold of inflation. And I think when you look at what's happening in the banking sector right now, I think people are starting to take a step back and say, well, maybe the Fed has gone too far too fast.
Yeah. And to be fair, I was not in that camp last week. I was proposing higher for longer. This is before all these banks failed, right? I mean, it's a different world. Everything's changed with what's going on right now. I mean, you don't have a normal world where the Fed has to do an emergency meeting on Sunday at 6 o'clock, 7 o'clock. That doesn't happen, right? They wanted to get ahead of the futures market. But the world changed. And you know what? I don't know if the Fed's going to hike. Now, here's the crazy thing. All right, let's just talk this out for a second. Okay, the Fed's backstopping the deposits. So what are they really doing? They're trying to prevent a run. They're trying to calm people, like, you don't have to withdraw the money. It's protected no matter what. So the banks could fail. And you'll get your money back, right? Not the equity and the bondholders, but I'm talking about the depositors, right? Why would they do that? Well, one thing that comes to mind is they want to punish the banks for bad behavior, right? Which is what they're doing. Like, if you're a Silicon Valley Bank person, you're not a happy camper. You just lost everything. It's sad. They took mismanagement. They did a lot of bad bets. They made a lot of money along the way, but it's sad, right? But one thing the Fed might be doing is, if inflation is still sticky, they could still hike rates. But that terminal rate, we talked about the terminal rate, and we're going to pivot here. The terminal rate, that's the Fed's expected future peak rate. I don't know how else to describe it, John. Is that right? Okay.
That's a good explanation too.
Okay. In case you've never heard that word, it's not where the rate is today. It's where the market expects it to peak, right? The Fed terminal rate. And what's caused this whole problem since last May is inflation's a problem. And that Fed terminal rate, basically, hey guys, we got to raise rates to combat inflation. The terminal rate keeps going up, and it's been going up from, look on the side here, it's been going up from 3. Here, let me see if I can do it. From 3, to 3.5, to 4, to 4.5, to 5, to 5.5. And every time that goes up, the stock market goes down and interest rates bump up and reset higher. Now that terminal rate, the blue line, that terminal rate before, I guess last Thursday, Friday, look at where it was. It was, oops, I can't draw my line because I can't see my cursor. It was right around 5.5%. And now, after this whole 3 days that just happened, and how the world changed, that terminal rate, where's my cursor? I can't even find my cursor because I'm telling you, there it is. That terminal rate has moved straight down. That's today. And it's at 4.9. So basically, are they even going to hike at the next? Now, personally, what the CPI prints tomorrow, that's going to tell all.
Yeah, no, I was going to say, but what's interesting this time is you would think last week, right before all this happened, you would think that, all right, a decrease in that terminal rate might imply mortgage rates ticking down. But here now we have a completely different situation. We have more risk in the system, and the idea that the Fed's going to lower interest rates to sort of, let some cash in there to sort of alleviate that risk. But you go back to what's happening. Just talk about that duration that you were talking about earlier in this program. The idea is that rates and prices in bonds are inversely correlated. So if you've got a long dated bond, 30 years, 10 years, whatever you want to do, as interest rates rise, the price on that bond is going to fall. It's very similar in real estate, especially commercial real estate, which lives and dies by the cap rate, right? The cap rate, you divide the price by the cap rate, and that should give you your valuation. Sorry, you divide the net income by the cap rate. That should give you your valuation. As that cap rate increases, right, as you should be getting more, the price on your valuation is going to fall. And so you've got a lot of lenders out there, not necessarily Silicon Valley banks that had it all in 30-year treasuries, right? Totally riskless, right? Except that it's got a long duration. You've got a lot of banks that are holding commercial loans. And if they have to start getting marked to market, well, what's going to happen? Well, they're going to look at those loans and say, oh gosh, this fleet of buildings, this portfolio of buildings that we have marked as 100 million really is now worth 60 million. Okay, well, what does that do to the assets of the bank? And that's what I think you're starting to see at First Republic and some of these regional banks that are holding more of these loans.
Yeah, and we have Ben Willig on the call here, and he has a really good question. We're gonna get to some questions. You guys got questions? Hit it in the chat right here in the Q&A. We'll get to them in the last 10 minutes. Ben asks, there have already been some commercial real estate loan defaults. A sustained high rate environment with these loans coming through could cause more delinquencies. 16 billion in New York City coming due this year. There was 1.7 billion that recently went under. I think maybe those and small businesses with floating rates and bad business models are biggest risk. Thoughts?
Yeah, I totally agree. I mean, I think this is one of the things that we're witnessing right now is interest rates have moved a significant amount in a short period of time. And we really haven't had enough time to sort of understand what those effects are. And they're starting to see them. Yeah. Now, I don't think everything's going to be that bad. I mean, there are a lot of businesses who have floating rates, but are also raising prices at the same time. So that's, that you're getting some push and pull effect. But it's going to be a while. Sometimes these payments are structured where it takes a few months, maybe a quarter or 2 quarters, in order to start feeling that pain. So I think there is definitely some pain coming, and it's going to be in unexpected places. Yeah,
I unfortunately agree. I think, if I trip back to the great financial crisis, time and place, guys, when these kind of days happen, they get long, but if you go back in time, there was a hit, and then the Fed came in, and then there was a sharp rally, and then it's like another domino fell. And then the Fed came in, then another domino fell, and it rallied each time. And each time we rallied, we're like, all right, we got it covered. We got it covered. And it was like after the 15th, 20th time, we're like, maybe we don't really know how deep this thing goes, right? I think we're in somewhat of that scenario. The differences are the Fed has the playbook. The Fed has the playbook. So that's one thing. However, the inflationary environment is the X factor here. And this is what's the pull and tug right now. I mean, if you really say the Fed's pushing on a string, or they're at a rock and a hard place, it's the best analogy, because what are they going to do? What if that CPI print comes in hot? What if the labor market continues to be strong? What if all the inflation prints going forward continue to come in high right when this banking crisis is starting to get going? They're not going to be able to cut rates. What has to happen is these banks need to raise their banks are offering 0.5% to keep your money there. And you could go and get 5% on a T-bill, 4.5%, 5% on a T-bill. Banks gonna have to raise their rates. They don't want to do that because it's going to kill their profitability. So they're keeping it like that. There's a lot of reasons why people can take money out of banks. There's a lot of reasons. So I don't know if what the Fed is doing here today, there's a moral hazard thing going on already. There's a moral hazard. Do you see systemic risk, John? Is this a systemic risk thing right now? Is this a contagion? I
don't know in a sense, yes. I think what you want to do is calm the emotions of the market right now. And I think a lot of people, Peter Thiel over on Wednesday, Thursday was like, take your money out of SVB because their balance sheet is horrible and they're going to run out of cash. So people freaked out, pulled the money out. You have a bank running in your hands. And I think what the Fed is trying to do is get ahead of that, calm people down. Hey, we've got this. Don't worry about it. But you know what I'd like to do, Noah? I'd like to bring this back, if I could, for a minute to New York City real estate. And what does this mean? I think, on the macro side for real estate, to me, this is a layer of uncertainty. And, one thing buyers absolutely hate is uncertainty. I don't think this is end of the world uncertainty. I don't think we're seeing anything like we saw in 2008, 2009, when the uncertainty is the economy going to collapse? Am I going to have a job? I don't think we're seeing that. I think it's just kind of like, oh, well, what's happening? Wait a second. Are banks safe? Right? There's this, it's sort of a weird new style of uncertainty. And honestly, I wouldn't be surprised if I saw people think, I'd rather hold my money in real estate than a bank at this point.
Well, I've talked to some people who I consider very smart, and they are big believers in hard assets, hard tangible assets. My position is that Manhattan real estate right now is in a very near-term up bump. You guys can see it on this bottom chart. By the way, in case you guys want to notice, premium research, premium tools, premium research, premium tools. It's all on the dash right here. Nothing was taken away. We just had to find another place to do it. Guys, look at Manhattan real. Look at the liquidity. This number has to get updated. This is really 958. My engineer is going nuts over that. But look at this liquidity right over here, and look at that bump up. And we're almost getting to a seller's level liquidity. I don't expect this to last forever. This is like a gift of liquidity right when this stuff is going down, that you're having deal volume in Manhattan. So I think we're weathering the storm. Maybe what you're saying is got some validity to it. that real estate as a tangible asset is going to be one of those things. And you look at Manhattan, there's some core value in Manhattan. We did not do what other housing markets did. We're still not at full capacity. We've talked about this. We're not at full capacity. We still don't have the commercial sector. We don't have the foreigners. We don't have the foreign investors, the foreign students, the foreign businesses, right? Ground floor retail. That's going to come online. But we are exposed to this. I'm looking, pointing at my TV over here, CNBC. We are exposed to this situation. And I just wanted something eerily familiar. Like, I think there's 25 billion that they're using to backstop the deposits. If this happens with some more banks and they start adding, again, this is a systemic risk exception. Where is this here? Where's the word? Right here. Right here. Systemic. I got to outline it for you guys. Systemic risk exception for Signature Bank, New York. And they did it for Silicon Valley. I think, are they going to apply this here? One second. To all banks? I think they're going to apply it to all banks, right? And I think the number right now is 25 billion. So I think you're going to see in the future that they're going to have to expand these facilities.
I wouldn't be surprised. And if I could just pause 1 second, we have a question. Can you briefly explain what the terminal rate is? Sure. So the Fed has been raising rates to fight inflation. And the question is, how high is the Fed going to go? No one knows, because we don't know what that final rate of the Fed is going to be. The final rate is the terminal rate. So at what point does the Fed stop? That's the terminal rate. And that is sort of the open question. That's what those blue and the orange curves show us. That's what people are guessing where the Fed is going to stop.
Yeah, the blue line is March 10th. Okay. So you got to go back in time to March 10th. That was Friday, right? The orange line is today, right? These futures expectations, they're like future guesses. All right. Look at the bottom of the chart. It's going all the way out to January 24 on the right. It's it's March 23. It's like, well, what? It's looking at, all right, well, what's the Fed going to do? Now, all of this is dependent on the world, right? We don't know what's going to happen today, tomorrow, the future. You got bank failures happening. Now the Fed's got to go in. Basically, what this is saying, there's no way the Fed is going to hike 50 basis points next meeting. That's what happened here, guys. The terminal rate gets way down, and like, all right, he's not hiking rates all the way. We did think he was last week because of inflation, and there was no bank failures. Now you got bank failures. Now you got the systemic risk situation out there. You got moral hazard talk out there. You got contagion talk out there. It's enough to get people to withdraw their money. The Feds, it's like, are they going to now really pour gasoline on the fire? And the expectation is no. So that terminal rate has to come down. Okay. Now, there are good reasons for that to come down and bad reasons for that to come down. If that terminal rate came down because the CPI print tomorrow comes in low and inflation's getting under control, that's a good reason for the terminal rate to come down. If the terminal rate comes lower because there's a systemic risk of a bank run and they have to contain a banking situation, that is not a good situation for the terminal rate to come in. So again, I don't care what the stock market's doing today. All right. This is, again, do you care what the stock market was doing back in mid 2007? Right. By the way, this is what put UrbanDigs on the map, Johnny. This is what put UrbanDigs on the map. When the hedge fund started going in the summer of 2007, you can see Bear Stearns right over here. If you've ever seen Margin Call, that's a great movie, Margin Call. The ABX indexes, the mortgage market started collapsing. And I saw that. I saw the credit markets starting to do weird things. I didn't understand it, but that's what started it all. And you got to see where this goes. It takes time. You can have rallies and then it can just slowly go down. So this is the environment we're in for the next 6 to 8 months. All right. More questions. I want to go back to Roberto. He had a good question here. With everything that has happened over the weekend, I'm hearing that rate hikes could actually see a pause, abandoning inflation reduction for the time being to stabilize and prioritize the U.S. economy as a whole. Are you hearing the same? What does the futures Fed funds rate chart graph look like today as it relates to the terminal rate? As you guys pointed out, from late January, it went from 4.9 to 5.4. It's right back down to 4.9. It's right back down to 4.9. And right now, the thought is, either pause and see what happens or hike at 25 and then pause and see what happens. Goldman Sachs expects a pause and then a hike in the summer. So this is the crazy part of the equation, guys, is that this is what's different. In 2008 and 2009, there was no inflation problem. Right, John?
Right. No, this is the inflation problem is caused by the solution to that problem.
Right. Exactly.
Right.
Exactly.
You into quantitative easing. So now we're in quantitative tightening. It's like, oh, now we have a new set of problems.
I said it before.
That's the water balloon. You're squeezing it. The pressure has to go somewhere.
Powell wants to break something. He wants to break something. He doesn't want to create a credit event like Lehman. He wants to break something. He wants to prove a point. His legacy is at stake. If he folds here and goes back and forth, it's going to look ridiculous on him. Especially for Silicon Valley Bank, they should not get bailed out. No way, not those guys. I mean, they're lending out money to cryptos, to SPACs, and all these very risky.
Well, they removed the senior management at Silicon Valley Bank. I think that was part of the deal.
Oh, yeah,
whether or not there's some golden parachute buckled in that
they got paid
documentation.
Before.
I'm not sure. They did.
Yeah,
but let's go back. We got a couple of questions, and these are interesting questions, right? What happens to a buyer with a pending mortgage application at a bank that fails? Is there a way for the loan to still close after the failure? Honestly, I don't know. I would guess not.
Well,
I don't know.
Or the bank that within hours you're going to find out somebody's buying this bank for $1, Bear Stearns style. I don't know. There's probably an auction going on right now. If you go to Bloomberg and type this in, someone's going to buy this. I don't know if they now take over those processes or not. I really don't know.
Yeah. And then Janet asks, is there a conversation to be had with clients about moving forward with mortgages from smaller lenders as opposed to bigger banks, larger banks?
Yeah. Go ahead, John.
I don't know the answer to that question either. I mean, look, if you have a mortgage from a bank and the bank fails, you're still on the hook to pay that mortgage, right? You can't get out of that. I still think the question comes down to, are you getting the best rate possible, and are you able to close? I think those are the two things that I would be focused on.
Yeah. I don't know. The regional banks are in a precarious spot here. So just be wary of the regional banks. This thing tends to be like a domino type thing. And again, the Fed said they're not bailing out the banks, so they're going to let them fail. They're going to protect the depositors. So this is new territory for everyone right now, because we don't know what's going to happen, and we don't know what the Fed's going to do in response. This is like all right, let it happen, react, let it happen, react. This is a reactive market market right now.
Right. And I think if you are a bank who's doing mortgages, you are probably going to be tightening down your application. You want the best mortgage possible. You do not want any sort of substandard thing slipping through, because that's just going to look really bad on your portfolio.
That was a question right here. Do mortgage lenders now tighten this underwriting procedures, and do they have the same access to capital? Yes, that is a consequence of this. That is a big consequence. Expect much tighter lending standards right now. Expect it to get harder to get that loan. Everything's going to tighten up. Everything's going to tighten up. And I wouldn't be surprised to see rates go up. I wouldn't be surprised because of what's going on. Because you got credit risk, you got duration risk, you got credit risk, you got convexity risk. I'm not going to go convexity risk, but you got all these different things, right? And so far it's been duration risk, and now it might go to credit risk. So yes, very good question. Ben, 2008 was driven by real estate fallout, created more foreclosures, increased supply. This is potential a commercial lender and business owner dilemma, and not necessarily a direct hit on New York City real estate, despite more pain. Also important to keep in mind is that Silicon Valley Bank and Signature were too small to go through the stress test of short-term liquidity that the big banks had to do. Bigger banks are much more liquid. I would agree with that. Bigger banks are in better shape. This seems like a different version of the savings and loan crisis. Yes, I was just discussing that with John before this session. This feels to me like a savings and loan crisis. And if you go back to then, they let thousands of banks fails. I don't know what the number was. A lot. Every other day was another bank failure, right? Yeah. That's what I think this is. And you had inflation at that time too. And I don't think the inflation thing is done yet. That's my unfortunately, the CPI print tomorrow. Oh my goodness gracious. Oh my goodness gracious. If that CPI print comes in hot, I don't know what's going to happen with the markets. Yeah. Is First Republic next, Johnny? Could this have a domino effect?
I think that's exactly what the Fed is trying to prevent. And I think they're trying to calm markets. They've got the term package out there. I think what short sellers are doing is they're going through every single regional bank, looking through anything publicly listed. They're going through the balance sheet and they're saying, just short it. I'll buy it back cheaper later. I think that's the play right now, or at least that's the play. That was the play Thursday, Friday. So, I'm looking at First Republic. I think it's down, 70% on the day or so. This is it.
It was at 143 on February. It was at 122 a week ago. Right. It's at 20. This is exactly what we're talking. Any bank that has their duration exposure right now is in bad shape.
Right. But see, now First Republic has access to, most of these banks are going to have access to this new term program. So I think there's going to be a bit of a backstopping. And even if they're not explicitly categorize, I don't think the Fed is going to want to start letting banks fail back and forth. Will they let some fail? Yeah, definitely. But
yeah,
I think they're going to do their best to contain this as much as they can.
This is a fluid situation. Like it's the convergence of high inflation and this situation at the same time that I think is so new to all of us. Like we haven't had both of this before together. So this is going to be a fluid situation for weeks and months and quarters until this cycle plays out. I mean, I wish it would be fast and furious to get it over with because we always recover, but I don't know. In regards to information you provided, what kind of conversations should we be having with our buyers and sellers? Okay, I have my opinion. John, you can give your opinion. First off, I'm glad you asked that question because this class, this Monday macro class, this was not created for you to go and talk to this about your clients. This was for us to talk to you and to share our thoughts so that you have an understanding of what we're going on or what we think is going on. Choose to listen to us or not, or have a different thought. It's totally okay. This is not investment advice, but this is really to up your game, to think differently and to think about things that you maybe haven't thought about before. I think you should focus your efforts on the data of Manhattan real estate. For example, the facts are this: we are in a rising liquidity environment. 950 deal volumes going up. Supply is starting to go up, but it's still tight. And the liquidity, the deal volume is going up. This is going to keep going probably until, I don't know, April or something. What's going on out there is not impacting this yet. It's not impacting this yet. And if the Fed just did their thing and protect us, it may not for a little while. So I would do what your clients expect of you. Be that expert on what's going on now. If I'm a buyer right now, hey man, I'm sorry, but what you're seeing out there is not really just causing a 10% drop in the market. So you're not seeing it. In fact, deal volume is going up and you may find competition. Hey, seller, get the hell out. Get the hell out. Like you have, I mean, what are you waiting for? This is it. March, April, May is your peak season. Deal volumes, it's a gift. Look what's going on out there. Like any seller says, I'm going to wait for a better bid. You know what I'm saying? That's crazy. If it's a good bid, I would take it and run. If they're thinking of selling in the future, like September or October, that's a lot of uncertainty. That's a lot of time. I would get it done now, in my opinion.
Yeah, I tend to agree. And, I think a lot of that comes back to if you're a seller and you're locked in at a 2 mortgage rate, right? You're sitting at a very sweet rate. Why are you interested in selling? If you want to sell and move away, this is a great time to do it. As you pointed out, we're in neutral liquidity area. We're actually approaching high liquidity. I'm not sure if we're going to get there, but it's a liquid market for sellers. But yeah. If you're just thinking about trading up, this is a very difficult time to have that conversation because, yeah, you'll probably be able to sell, but, there's not a lot of supply, right? We haven't seen a lot of supply coming out of the woodwork. And, if you need a mortgage for that, I mean, that environment now is a lot more fluid than it was a week ago. Yeah.
And I'll show you guys a tool that I've created for John and I. I actually have to go to my dev site because you guys do not have access to it. It's our performance index that shows where price action is according to this neural network, artificial. It takes every data stream I got.
Well, while you're doing that, I'll answer. There's a question. Did you hear anything about Charles Schwab? And it's also down on the day. I think it's just one of these things. People are just going in and they're revaluing the financial sector. So Schwab has trillions in assets. They've got access to all kinds of billions in the back end. So they put out statements saying that they're fine. It's a question of, what does the market believe? And I think the market's just going through and essentially just revaluing those things.
Yeah. And what John's talking about here, revaluing those things, guys, Schwab probably has $175 billion in long dated US treasuries that are now probably worth $65 billion. And they hit $175 billion and they're worth $65 billion. So what do you do to that? You move it to your held to maturity book. HTM book. You guys can look at this stuff. You take that and you move it to your HTM. It's like a little accounting gimmick, but the street knows it. And that's why they're punishing Schwab. It's the same thing for all the regionals. These guys are loaded on long duration treasuries. Okay. And it went against them for the last rates went up and it went against them. And the value of those treasuries today are much lower. So either they sell them for a hit or they just move them to a different part of the book, kind of a thing. This is my index on price action, guys. If you thought the market has bounced back in the last few months from November, December, it has. And according to my index, we're still down. I mean, look, we're down from the peak in 2014-15. We're still down from last peak in April, but we're not like an aggressive decline. We're not tanking. like the great financial crisis. That's not happening here. So this little bump up, that's because of the bids and the liquidity and the environment that you guys are seeing. I would take advantage of that. In my opinion, I don't think this is going to go like this. No, I think this is going to do one of these things, turn over, and then maybe go back down a little bit. For buyers that have time, I think there's still going to be a great opportunity in the near future for this market. So very interesting stuff, Johnny. Listen, thank you so much, guys, for joining us. John, unless you have anything to end with, we're gonna wrap this up.
No, it was a nice introductory class. Yeah, I don't say class. It was a session. It was good stuff. I enjoyed. This is how we start out our days every day. Just like, what just happened in the markets yesterday? What are you doing? What are you doing? This is what we do.
Yeah, this is what me and John do, guys. In case you guys are wondering, we talk about this stuff endlessly so that we understand each other's point of view. We look at the data. Now we said, why don't we make a class out of this? Let you guys join in and ask, this is what this is. It's going to be very interesting, guys. Thank you so much. You can join these classes on UrbanDigs Tuesday, Wednesday, 11 o'clock. Have a great day. Good luck to everyone. Close them deals, and we'll see you next time.